Just a few weeks ago, it really felt like the dream of a mortgage rate below 6% was right around the corner for so many homebuyers. But in a pretty dramatic turn, that hope has, well, it's pretty much vanished. Okay, so let's dive into what's going on and why your plans for this spring might need a serious second look.
So be honest, were you one of the people banking on locking in a lower rate for a new home this year? I mean, it was the talk of the market, right? It felt like a light at the end of a very long, very expensive tunnel for anyone trying to buy a house. Well, this is the number that changed absolutely everything. The average 30-year fixed mortgage rate suddenly rocketed up to 6.53%. And that is a really tough pill to swallow, especially when it felt like it happened overnight. So yeah, let's break down this new reality. We're not just talking about a tiny little fluctuation here. This is a major jump, and it's basically resetting expectations for the entire spring home buying season. And what's really wild is just how fast this all happened. I mean, look at this. In late February, we had actually dipped below that magic 6% mark. People were getting excited, but fast forward just a few weeks to March 20th, and boom, we're at 6.53%. That is an incredibly sharp climb in a super short amount of time. And to put that in perspective, we haven't seen rates this high in over half a year. So for all the buyers who are patiently waiting for that perfect moment to strike, well, that moment now seems to be moving further away, not closer. So the big question is, what on earth caused such a sudden U-turn?
Believe it or not, the trigger wasn't some new policy from the Fed or a typical market hiccup here at home. The source of all this volatility is actually happening thousands of miles away. Let's connect the dots. This timeline just lays it all out. Plain and simple. In late February, things were looking up. Rates were falling. Then, about 3 weeks ago, the war in Iran began. And you can see it right here. The trend immediately reverses, leading us straight to today's 6.53% rate. The connection is pretty hard to ignore. But how exactly does a conflict on the other side of the world translate into a higher monthly payment for a house in, say, Ohio or California? It's all about a global ripple effect. A chain reaction that starts with instability and ends right in your wallet. So here's how that chain reaction works, step by step. First, the war creates massive uncertainty, and that drives up global energy prices. Then, rising energy costs spark fears of wider inflation across the board. To hedge against that inflation, investors start demanding higher returns on their long-term bonds. And since mortgage rates were super closely tied to those bond yields, they get pulled right up along with them. It's a textbook case of global economics hitting your kitchen table.
This slide really captures the whiplash the market is feeling. I mean, before the conflict, the entire conversation was about when the Federal Reserve was going to start cutting rates. Now, almost overnight, the chatter has completely flipped to the possibility of more rate hikes. What a turnaround.
And this isn't just speculation. Look at the data. As of March 20th, traders who bet on this stuff are pricing in a 40% chance of a Fed rate hike by October. But here's the really stunning part. The day before, that probability was just 6%. 6%. That shows you just how fast and how dramatically the mood on Wall Street has shifted.
Okay, so we've covered the what and the why. Now let's get down to the part that really matters to all of us. What does this actually mean for your bank account?
Daryl Fairweather, who's the chief economist over at Redfin, she puts it pretty bluntly. This volatility has a direct and very real cost. So let's actually try and quantify that cost.
This is the number to really let sink in. $168. That's the immediate bottom line impact of this rate spike.
So to put that into perspective, let's say you were buying a $600,000 home with a 20% down payment. Your monthly mortgage payment is now $168 higher than it would have been just 3 weeks ago. That's over $2,000 more per year, just gone because of this shift.
All of this, of course, leads to the one big question on everyone's mind. What happens now? With so much up in the air, all eyes are on the Federal Reserve.
The Fed's official game plan right now is what you call a wait-and-see approach. And what that really means is they're hitting the pause button. They're holding rates steady, watching all the economic data, and seeing how these global events play out before they make their next move. And at their meeting this week, they did exactly that. They kept rates where they are. But, and this is a big but, they admitted that a rate hike was at least on the table for discussion. And even though they said one isn't planned right now, just the fact that they're talking about it is enough to pump the brakes on what should be the busiest time of year for real estate.
And that leaves us with this final critical question. For all the buyers who were geared up and ready to jump into the market this spring, the Fed's wait-and-see approach suddenly becomes their own. But in a market this unpredictable, is waiting really a risk most people can afford to take?